diluted earnings per share at $2.59, which is up 4% year over year. Revenue and net interest income hitting $4.61 billion, up 2%. And the forward guidance. Full year 2026 EPS outlook officially raised to a range of $9 to $9.25 to $9.50. Now, you've been tracking the broader retail environment, so you know the dominant narrative right now. Every single morning, there's another headline dissecting the looming consumer debt spiral. We're constantly told the American consumer is tapped out, squeezed by inflation, and just retreating rapidly.
Oh, totally. The doom and gloom is everywhere.
Right. But then you look at these actuals from Synchrony Financial's Q2 2026 print. I mean, this is a business entirely predicated on consumer credit and retail spending. And they just posted a solid beat and raised their full-year outlook. So for a retail investor trying to analyze this space, there is a severe disconnect between the macro anxiety we constantly hear about and the micro execution we are actually seeing in this report.
There really is a stark divergence between the sentiment and the hard data. I mean, when you look at the underlying mechanics of how Synchrony achieved that $2.59 EPS, it really forces a complete reevaluation of how stressed the consumer actually is. Like, we aren't seeing a retreat in the numbers, we're seeing an adaptation.
Yeah, so let's pull the data on that adaptation, starting with the core engine of their revenue, which is purchase volume. It hit an all-time high of $49.8 billion in the second quarter.
Wow.
Yeah, an 8% increase year over year. And loan receivables reached $102.2 billion. So, I mean, the volume is undeniably there. But here's where it gets really interesting. When you read through CEO Brian Double's commentary, things get a bit complicated. He specifically pointed out that out-of-partner discretionary spend, when a consumer takes their co-branded card and uses it for everyday purchases outside of the specific retail partner, grew by double digits.
Right. He listed categories like entertainment, retail, and electronics.
Exactly. But I have to push back on this. Because in the very same breath, management cited elevated fuel prices as a distinct headwind for their customer base.
So wait, how are we seeing double-digit growth in concert tickets and new televisions when the consumer is demonstrably losing disposable income at the gas pump?
Well, what's fascinating here is it seems totally contradictory until you look at the specific demographic of the Synchrony cardholder and really the utility of the co-branded products they hold. The absolute dollar amount of spending isn't necessarily jumping because consumers suddenly have more free cash.
Okay, so what is it then?
Instead, we're observing a deliberate shift in where and how that capital is deployed. Synchrony's growth this quarter is heavily anchored by their value-oriented partners and businesses offering highly diversified retail options.
Meaning the consumer is basically trying to engineer a yield on their everyday spending to offset the inflation they feel elsewhere. Precisely. Like, if fuel costs are eating into your monthly budget, you might not just cancel your plan to upgrade your appliances or buy electronics, but rather than paying cash at a specialty boutique, you execute that purchase at a large-scale, big-box retailer where your co-branded store card offers, say, 5% cash back or a 12-month 0% financing window.
Right. They're utilizing these specific credit products as defensive financial tools.
Exactly. They are optimizing their liquidity. Synchrony benefits from this behavioral shift because their partner network inherently leans toward those everyday value providers.
So they are hunting for the promotional financing terms and the rewards points, which makes sense from a consumer psychology standpoint, but from an investor's perspective, it immediately raises a red flag regarding credit risk. We see they are swiping for big-ticket items at higher volumes, pushing loan receivables past $100 billion.
Right.
But the real test of this model isn't the origination, it's the repayment.
Let's look at whether these are healthy loans or ballooning liability, because high purchase volume is actively detrimental if the credit quality is deteriorating.
And that is the exact pivot point where this earnings report separates itself from the macro anxiety. CFO Brian Wenzel delivered credit metrics that run completely counter to the idea of an over-leveraged consumer base defaulting on their obligations. Net charge-offs actually fell to 5.43%, down from 5.70% a year ago.
That is a highly notable contraction given the broader industry trends we've been tracking, and the early-stage delinquency data backs it up. Loans 30-plus days past due dropped slightly to 4.16%.
Yeah, and their allowance for credit losses is sitting safely at 10.09%.
Okay, but before we declare the portfolio bulletproof, let's unpack this because there's some real friction in the accounting here.
Oh, you mean the net interest margin expansion. That's a crucial piece of the profitability puzzle. MIM increased by 30 basis points to 15.08%. And that was primarily a function of two things: lower funding costs on their interest-bearing liabilities and a $163 million reserve release.
Right, and that reserve release is exactly where I see a potential conflict in the narrative. We have charge-offs and early-stage delinquencies trending down and NIM expanding, but simultaneously their efficiency ratio crept up to 35.8%. And more importantly, their total provision for credit losses increased by $55 million year over year, hitting $1.2 billion.
Yeah, it looks a bit messy.
So how do we square lower charge-offs and a $163 million reserve release with an overall higher provision and rising relative operational costs? I mean, are they just masking underlying weakness with accounting maneuvers?
It's a completely fair question, and it requires separating operational strategy from CECL accounting mechanics. Let's tackle the efficiency ratio first. The bump to 35.8% isn't a symptom of declining operational leverage or bloated SG&A. Management was explicit that this increase is directly tied to strategic technology investments.
Oh, so it's tech spending.
Yeah, they are actively deploying capital into their digital infrastructure, underwriting algorithms, and partner integrations. It's a near-term drag on the efficiency ratio that secures the platform's scalability.
So we shouldn't view the 35.8% as margin degradation, but rather as CapEx flowing through the income statement to defend their market share.
Exactly. Now, to your second point regarding the $55 million increase in the credit provision against the backdrop of falling charge-offs, I mean, it looks entirely counterintuitive until you factor in the sheer velocity of their portfolio growth. Under current accounting standards, specifically the CECL model, an institution has to provision for the expected lifetime loss of a loan on day one of origination.
Right. The provision scales mechanically with the volume. It's like adding a new wing to your house. Your homeowner's insurance premium is going to increase simply because there is more square footage to insure.
Yeah, exactly.
Even if your neighborhood hasn't gotten any more dangerous,
Yeah.
the risk profile per square foot might be identical or even lower, but the absolute dollar amount of coverage has to go up.
That is the perfect way to contextualize it. The total provision is rising strictly because loan receivables grew to $102.2 billion. The denominator is larger. If you isolate the $163 million reserve release, it actually reinforces the strength of the portfolio.
How so?
Well, in previous quarters, Synchrony modeled for a severe macroeconomic downturn and provisioned accordingly. That downturn never materialized within their specific consumer cohort. Releasing those reserves now is an acknowledgement that their prior assumptions were overly conservative. They're growing the loan book aggressively, but the underlying risk parameters remain really well contained.
Which proves the value of looking past the headline provision number. But we know Synchrony's portfolio is not a monolith, right? The $102.2 billion in receivables is distributed across highly distinct verticals. If we want to understand the exact mechanics of this consumer resilience, we have to pull apart the segment performance. The growth rates across their 5 business lines were incredibly uneven.
Oh, absolutely. The variance there tells us a tremendous amount about consumer prioritization.
Let's look at the actual breakdowns. Diversified in value was the undisputed driver this quarter, up 12% in purchase volume. Management attributed that to partner expansion and higher gas sales. Then you have digital up 9%. Home and auto, along with lifestyle, both grew at 6%.
And trailing significantly behind is health and wellness, up only 2%.
But that aggregate 2% growth in health and wellness hides a fascinating divergence that they called out specifically in the report. Pet spending grew, while cosmetic spending dropped.
If we connect this to the bigger picture, that specific data point is invaluable if you want a real-time indicator of the American consumer psyche. It is a textbook demonstration of behavioral economics in a pressured environment. When household liquidity tightens, consumers engage in ruthless triage.
And the elective procedures are the first things on the chopping block.
Without question. Non-essential, vanity-driven items like elective cosmetic procedures are highly deferrable. You can push that expense out 6 to 12 months without any fundamental impact on your life. But veterinary care operates on an entirely different psychological axis.
Because it's family.
Exactly. To the vast majority of these consumers, a pet is a core family member. If a dog requires an emergency surgical procedure or expensive chronic medication, that is not categorized as discretionary. It is an immediate, non-negotiable expense. They will utilize a product like Care Credit to finance that procedure regardless of the prevailing interest rate environment.
Which really illustrates the stickiness of these specific lending segments. Synchrony isn't just financing discretionary upgrades. They are deeply embedded in emergency utility. And you see that thesis reflected perfectly in their partner retention and acquisition this quarter. I mean, they renewed their relationship with Suzuki Motor, which is now a 17-year partnership.
Wow, 17 years.
Yeah, and they refreshed the DI6 Sporting Goods card, launched the Milo's Pro Rewards Amex, but more crucially, to your point, they expanded their relationship with Amerivet, making CareCredit the exclusive financing partner, and they also renewed their partnership with Roto-Rooter.
The Roto-Rooter renewal is a brilliant strategic anchor for the exact same reason as the vet care. I mean, no one wakes up and decides to finance a plumbing overhaul for the fun of it.
Right, you're not browsing Pikes on a Saturday.
No, but if a pipe bursts in your basement, you are swiping the card. By securing these specific utility and emergency-based partnerships, Synchrony essentially inoculates a significant portion of its portfolio against typical cyclical downturns. The necessity drives the volume, and the financing terms capture the yield.
It totally recontextualizes their market position. They aren't just a proxy for retail optimism, they're infrastructure for household management. So the engine is clearly generating substantial volume, the credit risk is being managed effectively, and they've locked in these highly defensive, utility-driven partnerships. For the retail investor, the final critical variable to evaluate is capital allocation. So what does this all mean for what management is doing with the free cash flow this ecosystem is throwing off?
Well, their capital return strategy this quarter was incredibly aggressive, and really it serves as the ultimate barometer of management's internal confidence. They aren't hoarding cash out of fear of a macro shock.
The figures are actually staggering. They returned $950 million to shareholders in a single quarter.
Almost $1 billion.
Yeah, it breaks down to $100 million in dividends and $850 million deployed directly into share repurchases. And even after executing nearly $1 billion in buybacks, they are still sitting on a $5.7 billion remaining repurchase authorization. It's like a poker player pushing their chips to the center of the table. Management is betting heavily on their own stock.
Absolutely. And meanwhile, they're projecting a stable macroeconomic environment with no significant shifts in inflation, which supports their forward guidance of mid-single-digit loan growth.
I should also add that their other income line did see a boost from a one-off $30 million Visa B2 share exchange gain, which is worth noting for modeling purposes. But the scale of the buybacks is really the focal point.
This raises an important question, though, about how they are balancing that aggressive return of capital with their regulatory requirements and balance sheet security. Because despite the $850 million outflow for buybacks, their CET1 capital ratio remains robust at 13.2%.
Right, and maintaining a 13.2% CET1 ratio while repurchasing stock at this velocity sends a very specific signal to the market.
It proves that their capital position is highly resilient under internal stress testing. The CET1 ratio is, your ultimate safety net against unexpected credit shocks. It dictates a bank's capacity to absorb losses without facing insolvency.
So 13.2% is pretty comfortable.
Very comfortable. Operating at 13.2% gives them substantial buffer room. They are effectively telling the market that their internal modeling shows no imminent threat to their asset quality that would require hoarding that excess capital.
They look at the current valuation of their equity, they look at the underlying performance of their $102 billion loan book, and they are aggressively taking their own shares off the table. They're capitalizing on the disconnect between the market's macro fears and their own micro realities. Which brings us to the ultimate synthesis for anyone analyzing this quarter. Synchrony Financial is actively threading a very difficult needle here.
They really are.
They're capturing record purchase volume by leaning into a partner network that caters to consumer optimization and everyday value. They're enforcing strict underwriting discipline that is actively driving down charge-offs and early-stage delinquencies. And they're leveraging the resulting cash flow to heavily reward shareholders through buybacks, all while maintaining a fortress balance sheet.
It is a remarkable display of operational execution in an environment that honestly heavily penalizes any missteps in credit management.
And that leaves you with a critical, provocative thought to evaluate moving forward. We started this deep dive analyzing the pervasive narrative of an impending consumer debt crisis. The market is constantly bracing for the American consumer to hit a wall. But if Synchrony's internal data, representing tens of millions of accounts and billions of dollars in daily transactions, shows that consumers are still utilizing credit at record rates, actively prioritizing utility and necessity spending, and most importantly, paying down those obligations on time, is the mainstream consensus of a consumer debt spiral fundamentally flawed? Or is Synchrony simply operating with a much more resilient, structurally sound portfolio than the broader market realizes? Based on this quarter, it certainly looks like they are holding a winning hand.
They definitely seem to be playing it perfectly.
If you want to keep tracking the reality of the consumer economy and how these companies are actually executing behind the headlines, make sure you follow the show for our daily earnings coverage.